Hey, what's going on, guys? This is Terrence Ray back at you with the weekly stock market update. Right now, on Sunday, you can see we got the futures already popping. Already, the market is moving. We're about, well, we'll say roughly 2 hours into this Sunday session. We got the futures market right now. The S&P 500 futures are up about a little over a quarter of a percent. Same thing with the Nasdaq futures. The Dow futures and the Russell futures are almost up 0.5%. So right now, as we if I zoom in on the S&P 500, let's make it a little bigger so you guys can see. See, we already got a green day starting to move, right? Now I'm gonna pull up a chart of last week for the S&P 500, the SPX, and you can see last week we had a range for the expected move, and it kind of broke out. Excuse me. You can see it gapped up on Monday and Tuesday. So Monday we were kind of like right here, and then Tuesday it gapped up, and then we just kept moving, right? So it never looked back. Now, what I'm going to do, generally, I just stick with Tasty Trade. I'm going to switch to ThinkorSwim because I want to show you something in ThinkorSwim. So here we go. Now, with this indicator, I got the expected moves pulled up for previous weeks, right? So you can see for 3 weeks, basically the expected move held basically 4 weeks. So here was a week right here. See, opened up here, here, here. This was Friday. Just kind of stayed in between the range. It was the downside and the upside stayed within, right? So if you would have sold something here, you made money. Right here, same thing. The next week, stay within. Week after that, stay within. So basically, one, two, three. Shoot, you could even say four. Because here you go. See, it got outside, got outside, then pulled back on the last day. So for like 4 weeks, it finished the week inside of the expected move range. So outside it now, last week we broke higher. Now for the week, now this is only a 4-day week. Trading may be kind of light, but hey, I could be wrong. I was wrong last week. The expected move for the week is $67.80, right? Because we going to end the week on July 3rd because the 4th is on Friday and the markets are closed. Now we go back here, we'll see that's going to put us right up here. Now, I don't think that we're going to get there. Let me show you why. We got automatic trend lines. Now I'm going to take these, I'm going to remove this study so you don't see the expected moves up there. And you just see this trend line automatically drawn from got a touch here, touch here, touch here, and then it goes across to right here. And I would say right around 62.35 ish, somewhere right there is where we'll get to that up there. So I expect to see maybe some resistance right there, possibly. So we'll see. I don't expect a whole lot of trading this week, being as that it's a holiday. A lot of the traders will be getting out of there early, maybe shutting it down Wednesday, possibly getting ready to travel or whatnot. So, but we'll see. Now, what I really wanted to talk about this week, as you'll see in the title, as I got catching the fade. I'm gonna cook today. We're cooking with grease today. That like that old grease granny had. If you got if your grandparents were southern country, whatnot, you know, they recycle that grease. They cook with that grease and then get done cooking and they take that grease and then pour it back in that Crisco jar and then reuse it again, right? So that's the kind of grease I'm gonna cook with today. So with the market just going higher, so we can you can see right here, the market just drifting high. This S&P, this the SPX. If I would have just go back to, excuse me, if I just went back to, looked at some other stocks, we looked at Meta, look at Meta, just going higher, moving towards all-time highs up here, basically parabolic, you might as well say. Let's look at Amazon up. Look at it. I expect that to run higher. Look at let's look at Google. Look like it's getting ready to break out. Look at that candlestick on Friday. Like it's gonna take that high out. Let's look at Microsoft. This is crazy. That's crazy work right there. You can see the channel down here. You see it gapped up. This acted as support and it just kept running, right? Look at this hole right here. Look at this gap. Let's look at Netflix is crazy. Look at that up here at a resistance level. Look at this trend line right here, right? Almost like an expanding triangle, almost like a microphone, a megaphone. You know, like one of them cheerleading megaphones. Look at that. Just open it up, hitting it. Look like we're gonna get some resistance right here. So basically, look at Nvidia, right? So when I say catching that fade, you know, uh, the pun is intended. We are talking about fading the market. So this is all about like, now look, I still think the market is going to go higher overall, right? I am still bullish overall. But if we're looking at like a trade, making a trade, finding something that has that's basically a high probability trade, something that's small that you can take a shot to possibly, make a little money quickly, get in and out, maybe on like, fading at highs, basically a short. And this is something that, sometimes I talk to people, and they'd be like, man, I don't, I got a small account. I don't have a large account to be making, huge trades. The type of trade I'm getting ready to go over, you only need really about I'll say about $200 to do. Maybe not even that, depending on the size of the stock that you're doing it on. But probably you will want to have maybe about 500 in the account, and you're probably only going to use maybe about 150, to put the trade on, maybe 200, 250. But that's it. So you can get this trade on relatively small and have a good chance of success. So let's talk about it. Now I got a scan that I already ran. Now this is a little bit different than what I normally do. Normally I have some stocks set up, that's trending higher, but we're gonna do something different this week. So I'm gonna pull up my contrarian scan that I have, right? And we got a list of we got about 8 stocks over here, right? Now, this stock, even though this Nvidia didn't come up on this scan, but I would think that this would be a decent candidate, but it didn't come up on the scan. So number one is AVGO. I'm gonna pull it up here. Now I'll use the option chain on Tasty Trade because it's just easier to use. But we're gonna chart on ThinkorSwim right here. So if we're looking at this, guys, look at it. It looks kind of similar to the other ones. Basically, this is all-time highs, or at least a yearly high anyway. This is a 52-week high, if nothing else. This is a year chart. So if we zoom out, we can see that the market came up right here, blew past this resistance, came back and retested right here. You can see, and then went higher. I'm gonna zoom in on that retest. You guys can see the retest here on that trend line, and then went higher. Now, let's bring in some indicators. Let's go pull up what we're gonna use. Let's pull up we got the MACD pulled up and we have the RSI. I think you guys may not be able to see it because of my head. Let's see if I can move my head over. I'm gonna try to move this change this layout. There we go. Um, let's see if I can. I know it's a way to flip my face, but I ain't gonna worry about that because it's gonna have me looking the wrong way, and I don't know how to flip it. We're just gonna have to rock with it. But anyway, so you can see now. You can see if you look over here, you're gonna see my right down here in the corner. You're gonna see on the RSI, it's overbought. And we actually have divergence on the RSI on AVGO. See right here. You guys can see that red line. We're gonna draw another one right here on the MACD, even though the MACD just crossed over. Now you can see we got up here on the price action, we got higher highs, right? See that? Even though we got higher highs up here on price action, RSI, we got divergence. It's not making a higher high on the RSI or the MACD. So that lets us know momentum is slowing down. That's on AVGO. Now I'm going to pull up. Let's go to Tasty Trade. Let's pull that up and look at the option chain. Let's look. First of all, we want to make sure you want to do this on stocks that have weeklies, right? So you see this W right here to the left. So it has weeklies. This is just one of the ways that we look to see if it's liquid. Now on the Tasty Trade platform, if you look over here to the right on this little screen over here, I'm gonna see if I can make it bigger so you guys can see. Right here, it has 4 stars for liquidity. So it's telling so they're telling us that it's liquid based on their scale for liquidity. Now with these trades, I like to be 30 to maybe 55 days out. So we would come, maybe you can do 33 days, even though I don't like the markets here because I would rather be in the monthlies when doing this if possible. Unless you're in something like SPY or Apple, Nvidia, Tesla, something like that. Let's go to 47 days. Now you got $10 wide strikes. I wouldn't do this in a $10 wide strike just because it's gonna cost you somewhere right around 500 bucks. So we're gonna move on from this one unless we did like 33 days. Basically, you would come to the put side, you would buy one in the money, sell one out of the money, and you should be paying about half of the width of the box. Here's your box, 270 to 265. That's $5 wide, basically $500. So you don't want to pay any more than 250, maybe 255, possibly 260, right? So it's showing right now the market is closed. It's saying 225. That will tighten up when the market opens. Um, let's move on to another one just because I want to get a better example option wise. So let's go look at, I'm going to skip CrowdStrike, even though it's a decent candidate as well, but it's a $500 stock. NVIDIA did come up. I think I said that I like NVIDIA as a potential candidate. Now you see NVIDIA and it's green. Ideally, me personally, I want to do this on a green day. I like to see this gap up, come up here somewhere and do it somewhere right in here, right? Now, with NVIDIA, we should get favorable strikes because I know it's liquid. Now we're going to come to the option chain. Let's go here. Now we're going to go about 47 days. So it's a $5 wide as well. Now, if you look over here to the right, you see open interest. You see these numbers in K and they got a K. So these are thousands of contracts. That's on the open interest, and you see volume as what was traded on Friday. But by the time the market closed, even though it's a $5 wide, excuse me, it's a $157 stock, $5 wide strikes. And right now the market is closed and you still see 775 to 785 on the bid ask right here at the call. You got 10-cent wide over here on the put side, 15 cent. That lets us know that it's liquid. So we will buy one in the money on the put side, sell one out of the money. That's why I call it a in out spread, or some people would just call it a put spread, um, uh, a long put spread or something like that. But you can see we be paying about 232 for it. And if you look down at the bottom of the screen, you're gonna see the probability of profit is 52%. And then if you just making 50% of your total profit, you got a 67% chance of making money here. That's really that's a high probability trade. And all I'm looking to make, if I pay 232 for it, I'm looking to make basically 116. I'm looking to make half of what I paid for it. And then that's that. So if you lock that in and you will see if we looked at the analysis tab just to see what it looked like, show you guys what these trades look like on the analysis tab. Let's go. Might have to, no, not a pairs trade. No, not a pairs trade. There we go. Analysis there. And you can see we make money if the stock goes down. And then you see if the stock goes up, we lose money. Now, where would we need the stock to go to make our $1.16? That's what you want to look at, right? So you could do something like basically to make 116 by, let's look at tomorrow. So to get this, so I move, what I did was move it to tomorrow, which would be June 30th. So we would need the market to go down maybe to get 116. We needed to go to 145, right? That's just a $12 move, right? To make 116 by tomorrow. Now let's say by Friday, excuse me, Thursday, since Friday we close what we need. Now every day it's gonna change the further we go out. Now you see to make 116, we needed to go down to, let's say, 145 again still. So if we go to the next week, Friday, which would be the 11th, to make 116, we needed to go to 147. So in 2 weeks, if it gets down to 147, which is just $10, you make 116. If you just want to pull 100 out, you need to get it to 148. All I'm doing is moving this theoretical scale right here on the analysis tab to see what I can make and by what time. Now, we can make this a little bit because we put more time on it. Let's go back to the table. Let's say we did do, let me go back and clear that trade out. I think I cleared it out. All right. So let's say we went to 33 days, which is ideally probably what best to do, like 30 days. Now we got 2.5 strikes, right? So it's 160, 157. So we will buy one in the money, sell one out. Now for this 2.5, it's got us paying 120, which is about right. So if it's $2.50 for the box, you won't want to pay any more, maybe a little over half. So if it's 250 right here, this is the box, 160, 157 and a half strikes. That's the difference is 250. You don't want to pay more than maybe 125, 130. I would say 130 at the most, maybe 5 cents over the midway. If we're paying 120, we lock that in. You see down here, we got a probability of profit of 54%. We got a 67% probability of 50%. If we pay 120 for it, we maybe want to make $60 out of the 120 that we paying. So if you're gonna pay 120, basically that means you gotta sell it for 180 to get your $60 out of it. So all you would need to put this trade on is roughly about $250, the width of the spot box, to make this trade. So this is something cheap that you can do. These are small trades, small shots that you can take. And I'll probably throw this one on Monday just to put it on. Like it's something that, and then I'll set it and forget it. And over the next 33, if the market continues to run higher, you just lose the money. You have to be prepared to lose 100% of this trade when you put it in. But what you're doing is you're saying, hey, this market just look at this. Now I'm gonna show you all you need. Right now it's at 157, right? Let's go back to the trade. Now let's go look at this on the analysis tab because we want to see what do we need to make money on this one. Let's start back over. We're gonna go back to June 30th. We want to make, so we're paying 120. We want to make $60. We need the market to go to, I'm just moving here, 148. So we need a $9 move by Monday. And you say, well, man, we ain't gonna get that by tomorrow to go down $9. Okay, let's go to the third. Let's go to Thursday. What we need to get these $60. We need still about a $9 move, 148. Now, That's not taking into account like volatility being because if the market was to go down, vol would go higher. See, the IV rank is only at 7, that would increase. Let's go to the next week. Let's go to 7-11, right? And what would we need to get our $60? We needed to go to 150. So now, after a little bit of time goes by July 11th, all we need is what? A $7 move. So we get a $7 move, we get our $60 and get out of this trade. Just a $7 move. That is something, these are cheap trades that you can do that basically kind of like if you're not used to options and how they move, this is something to keep you engaged, don't cost a lot of money, um, helps you learn how options work, how they move. It's basically and it's called the in and out spread. It is not hard to remember. When you say in and out spread, you buy one in the money, sell one out of the money. You can do them on the call side, you just have to, yeah, it's just good. The dynamics gonna work a little bit different, but set it up the same way. On the call side, it would be buy one in the money, sell one out of the money, just like that. Now, I want to show you guys some. Now, I said what you needed like a $7 move by July 11th, right? Well, the expected move is $13 in this stock. So the expected move is what by the within 33 days to the downside is 145 and 170 to the upside. So it's very well quite understandably so that we could get a a $7 move by July 11th, which is what I don't know, what's that, 12 days, something like that, 11 days, 10 days, whatever, trading days. $7 will put us down to 150. So you can get that if the expected move is 145. That's what it is. Now let's go. Let's look at the rest of the stocks that's on here. They're all gonna look similar. They're all gonna be at 52-week highs. Look at SMH. SMH actually running right up against a trend line right up here. You see, almost got like two dojis right here. Same thing there. Let's look at snow. Look at snow. It actually went past this trend line and it's sitting right here. It's overbought on the RSI. Same type of trade. XLC, Communication Services ETF. Got two strong candles coming out. It's overbought as well. XLK, Technology ETF. See it right here. We almost got like a Harami on it. So if we were to get something back into here, I could easily see that rolling over. And even if it was to come back into here and then just take off again, you're out of this trade if it pull back into here. You get an 8, 9, $10 move in any of these stocks, you're out of this trade. You should be out. You'd be out. And so that way, if it rebound, which I believe that they will and go higher, you're already out. What's this? Z Scaler. Don't know anything about this stock, but it's overbought too. Look at it. So these are this contrarian scan, basically contrarian. We're taking a bet to go the opposite direction of the market. We are attempting to short the market at extreme levels. Like we're taking the other side, like, hey, we just need a little quick down move to the downside. Any little news, any tweet, anything comes out of the Middle East, and boom, we got that trade and we in and out. So that's what I mean. From now, when y'all hear the segment come on, and I'm talking about catching fades, that's what we're talking about. We're talking about fading the market, taking the other side of extremities. We got an extreme case in the market right now, and a lot of stocks to the upside. Uh, I don't care. It's been my experience that at some point it's going to stop. You know, it's almost not even healthy to keep doing like this. It just makes that down move when it comes. And it's gonna be fast and furious. You get some a quick little sell off for a few days, you get a little bottom, then you'll get it to go higher. So hey guys, Hey, hopefully you got something out of this video. Hit the like button. Uh, Share the video. Let me know what you think. If you need me to explain these in and out spreads a little bit more, let me know, and I'll go over them in another segment. That being said, guys, I am out. Peace.